At its peak, Norwegian Cruise Line was adding $1 billion of new ships to its fleet every single year, not borrowing to survive, borrowing to dominate. But somewhere between the champagne launches and the record passenger numbers, the math stopped working. The question nobody asked loudly enough was, what happens when the ocean runs out of room? To understand how Norwegian got there, you have to go back to 1966, when a Norwegian shipping company called Kloster Rederi sent a single passenger vessel from Miami to Nassau. The route was short, the ship was modest, and the idea was almost accidental. But Americans, it turned out, were desperate for exactly this: a floating holiday that required no passport, no planning, and no guilt about sitting still. Norwegian Caribbean Lines, as it was then called, didn't invent the cruise. It invented the mass market cruise. For the next 2 decades, the company quietly refined its model. Ships got larger, itineraries got longer, but Norwegian's real breakthrough came in the late 1980s when it introduced what it called freestyle cruising. No fixed dining times, no assigned tables, no formal dress codes. It sounds trivial now, but at the time, it was a genuine disruption. The cruise industry ran on rigid schedules. Norwegian tore the schedule up, and a new generation of travelers noticed. The problem with being first is that being first costs money. Norwegian spent heavily through the 90s expanding its fleet, and by 2001 it was carrying serious debt and flying dangerously close to bankruptcy. Malaysian conglomerate Star Cruises stepped in and acquired the company, a rescue that stabilized the balance sheet but didn't resolve the structural tension underneath it. Norwegian was a growth story trapped inside a capital-intensive business. Every new ship it needed to stay competitive cost somewhere between $500 million and $1 billion and took years to build. The real transformation came after 2007, when a private equity consortium led by Apollo Global Management took Norwegian private in a leveraged buyout. This is where the story pivots. Private equity and cruise lines share one obvious trait: they both love leverage. The buyout loaded the company with debt at precisely the moment it needed to accelerate. Apollo's thesis was straightforward: buy low, build fast, take it public at a higher multiple. Norwegian would become the growth vehicle. The ships were the proof points. Between 2007 and 2013, Norwegian launched ship after ship under its Norwegian Breakaway class program. These were not modest vessels. The Norwegian Breakaway, delivered in 2013, carried nearly 4,000 passengers and featured a full Manhattan skyline painted on its hull. A floating billboard for ambition. Each one was more elaborate than the last. Water slides, go-kart tracks, multi-story entertainment complexes. The ships were extraordinary. They were also extraordinarily expensive to finance, staff, fuel, and fill. Norwegian went public again in 2013 at $13 a share. Over the following years, the stock climbed sharply, and the company used that momentum to keep ordering ships. By 2019, the fleet had grown to 17 vessels under the Norwegian brand alone, with 2 premium lines, Oceania and Regent Seven Seas, sitting above it. Norwegian Cruise Line Holdings had become a genuine holding company, a 3-tier empire serving economy through ultra-luxury. The revenue was real, so was the debt. Long-term obligations by late 2019 sat north of $10 billion. This figure requires verification before publishing. The logic executives used was internally coherent. Cruise penetration in North America was still under 4% of adults. The upside, they argued, was enormous. Every ship added capacity, and added capacity drove revenue, and revenue serviced the debt while leaving room for profit. It was a flywheel. As long as the passengers kept coming, the math held. The fatal assumption buried in that model was that the passengers would always keep coming. That demand was effectively unlimited and that nothing external could interrupt the flywheel. In February 2020, they stopped coming entirely. The COVID-19 pandemic did not merely reduce Norwegian's revenue, it eliminated it. The company sailed 0 passengers for 15 months. 15 months of zero income against $10 billion of debt and a fixed cost base that included thousands of crew, port agreements, fuel contracts, and ship maintenance obligations that did not pause because the world did. Norwegian burned through cash at a rate that alarmed even seasoned analysts. This figure and timeline require source verification before publishing. To survive, Norwegian did what any company in extremis does. It raised capital at any price available, new debt at high interest rates, equity offerings that diluted existing shareholders, credit facilities secured against future ticket sales that hadn't yet been booked. By the time cruising resumed in mid-2021, Norwegian had added billions more to its obligations. The company had survived, but it had survived by pulling forward pain. The debt that was already heavy in 2019 was now almost structurally permanent, a weight the business would carry for the foreseeable future regardless of how full the ships were. When passengers did return, they returned enthusiastically. Cruise demand in 2022 and 2023 recovered faster than most of the travel industry expected. Norwegian's ships filled up. Revenue climbed. The stock recovered from its catastrophic lows. On the surface, the story looked like a comeback, but underneath, the interest expense alone was consuming a significant portion of operating income. Norwegian wasn't broke, but it wasn't free either. Every dollar of profit went to service obligations made during the expansion years, leaving little room for the flexibility a capital-intensive business genuinely needs. The structural lesson in Norwegian's story is not about a pandemic. Pandemics are exogenous shocks. They happen, they end, and companies recover. The real lesson is what Norwegian looked like before the pandemic arrived. A business that had financed growth entirely on debt, that had defined success as fleet size rather than financial resilience, and that had no meaningful buffer when the flywheel stopped. The ships were magnificent. The balance sheet was fragile, and in capital-intensive industries, the balance sheet is always the real product. There is a version of Norwegian's history where the expansion pauses in 2016, where the debt is paid down through a period of operational consolidation, where the company enters 2020 lean and survives the shutdown with a fraction of the damage. That version exists. Leadership chose a different one. The version where growth is the answer to every question, where the next ship always justifies the debt required to build it. It was a choice that worked brilliantly during the good years and very nearly didn't survive the first serious test. The ocean, it turned out, had plenty of room. The balance sheet did not.